The Boat Biz podcast with the MRAA. We have some incredible content lined up for you with this podcast that we're going to be delivering industry updates, insights that boat dealers need to be aware of, opportunities that dealers can take advantage of, and our favorite part here at the MRAA, actionable ideas that you can implement. First and foremost priority for us in everything that we do here at the MRAA is to deliver on our mission. And that mission is really to recognize that if our industry is going to be successful, our dealers have to be successful. So we drive the success of our dealers. It's something we're very passionate about here. And the way that we look at things around here, it's always a great time to be in the boat biz. All right, welcome everybody to the third episode of the Boat Biz podcast. Thank you for joining us. We are in the early stages of a busy fall travel schedule here at MRAA, where we're going to be traveling to many different dealer meetings and other industry events. In our last episode, as you heard, we were joined by Ann Baldry and Buck Pegg of Chaparral and Robalo Boats as they hosted their first in-person dealer meeting since 2019. This week I'm in Park City, Utah, where the National Marine Lenders Association is hosting its 2022 annual conference. The NMLA is a membership organization just like the MRAA is, and its members are banks, loan origination or service companies, credit unions, and other industry professionals. And a couple of the missions of this organization is really to educate lenders in marine financing procedures and to promote the extension of credit to consumer and trade borrowers. A lot like what MRA's mission is, right? Education and promoting the sport and getting people into boating and so forth. And that's why we're actually here. We wanted to learn about the lending market, and I am thrilled today to be joined by an expert on the wholesale lending side and one of the featured speakers of this conference, the managing director of the marine and RV side of Wells Fargo's Distribution Finance, Chad Lyon. Chad, welcome.
Awesome. Thanks, Matt. Appreciate it. Look forward to our discussion.
Yeah. So why don't we just kick this off a little bit with maybe a little bit of your personal background. You can maybe tell us where you're from, what type of boating memories that you've collected over the years and that sort of thing.
No, absolutely. So I grew up in Michigan, which is a fair amount of lakes. So did quite a bit of boating as a kid, on some of the lakes near Paw Paw, Michigan, where I was raised. So it was, part of the lifestyle. A little bit, and early in my career I was in the boat marine business for Transamerica, then for GE Capital. So I worked for Bruce Van Wagner, who I've succeeded in this role. So I've been involved in either boating or in the boat business for a good percentage of my career. So it's fun. I enjoyed it a lot.
Wow, that's great. And it looks like almost 20 years now with Wells Fargo or GE or Transamerica.
Actually, almost 30.
Almost 30, okay.
Almost 30, yeah.
All right. So tell us a little bit about how that career ladder happened. Where did you start in the business and how did you proceed through it all?
Yeah, no, so I started, the first role I had in this business was with Transamerica in Chicago, and they were big marine, they were big in the RV space. I was actually in the electronics and appliance business and underwriting credit for dealers, and had an opportunity to join the marine company. At that time was led by Richard Strickler, who was one of the legendary leaders in this industry. So worked for him. And then the merger happened with GE Capital, So that's where Bruce Van Wagner and Richard and I actually led the Brunswick joint venture that we're actually celebrating our 20-year anniversary on that this year. So we've had that relationship. So I was the general manager for that business. And then right before the financial crisis, I made a really weird career choice, and left the boat business. And some people say, well, that was really good timing. I went into the home furnishings business, and that's a little harder, was actually even hit a little harder than the boat business during that time. So, but then spent a little bit of time had just different roles within G Capital, and then most recently I was the leader of our electronics and appliance business, which is a fairly good-sized business. We do a lot of independent retailers. So if you think Home Depot, Lowe's, Best Buy, right, they're the big guys in this business. There's a lot of independent retailers that sell that. So we supported them, and then when Bruce announced his retirement, I had the opportunity to come back and spend some time in the boat business.
That's awesome. Welcome back. So today your title is Managing Director of both the RV and the marine side of the business. You alluded to this a little bit, somewhat of a new role.
Mm-hmm.
What is the role? What does your day-to-day look like? What does the year-to-year look like in your role?
Very interesting. It is a little. It's a lot of a lot. a lot of little things. So there's both businesses are very relationship intensive. So part of it is as I saw you last week at Chaparral and Robalo, it's getting out, seeing customers, seeing dealers, seeing the OEMs that participate in this business. So there's a lot of building relationships and understanding what our customers need is a big part of it. It's leading and managing the team. We have a lot of people that have been in this business a long time, which is great. However, that leads to retirement. You lose a lot of mind share, and we had several people retire over the last couple of years, and have probably a few more people in that same kind of lens over the next couple of years, is trying to figure out organizationally how do we succeed those, because we have such good leadership position in both these markets. We don't want to lose that, and the people are incredibly important part of our success. And then this is the boring part, but there's a whole lot of compliance we have to do as part of a big regulated bank, whether it's credit profiles, know your customer, and a lot of there's just a lot that have been part of a bank we just need to be right on, and so it's incredibly important for Wells Fargo and as an employee of Wells just do the right things.
Right. And historically, Wells has been very involved with carrying a dealer council, having dealer advice and insight. You mentioned being down at Chaparral Robalo last week with us at dealer meetings and that sort of thing. And I know we'll see your team at all of these dealer meetings as we're out there. Talk a little bit about that dealer connection and how you'd like to keep that close and continue to build that. Oh,
great question, because that is, to me, that is in the marine business, that is kind of our core DNA is the relationships. We cover the industry we have sales people that are in all core geographic markets, right? And they have dealer relationships where they work as help the dealers obviously navigate, appropriate credit, which lines they want to carry, and a lot of kind of day-to-day. But we also have invested a lot, which is some of the things I'll be presenting tomorrow at this conference is how we see the industry, where we see trends leading, where we see inventory levels, margins, things that impact businesses on a broader level. So we really want to bring that expertise and data outside to dealers. So it's a very, very important part of who we are and how we've set up the organization, and why these relationships have been so sustained for so long is there's such mutual benefit between what the dealers are able to accomplish and just the little bit of support we provide for them. So it is a really important part of who we are.
Absolutely. So you've talked a little bit about this with your team and so forth down at in Fort Myers at the dealer meeting last week. Peter and Ed and Brad were there with you as well. Tell us a little bit about the team that you manage and what their roles are and what role that they play with the dealers on a day-to-day basis.
So we have we call it, we refer to ourselves as the commercial organization, right? We're the business function within the bank. So we face the customers, and so that is kind of we have two kind of workforces. One handles the OEM relationships, which is led by Ed Bragg, and then the dealer sales led by Brian Toko. So Peter Harper is our field salesperson he's in Florida. He covers the Florida market. He is very engaged with the dealers in Florida. And then Brad Kelly was there. He covers Chaparral, and he covers actually the buying group, which is the ABA, which is one of the big buying groups that has their members. So it's a little bit of a different sell and a different relationship between the OEM and the dealer. So we have a little bit of a different sales force, but generally speaking, the concept's the same. We have expectation of how often we see the customers, how often we're engaged with them. We call market decks, how often we review kind of what we're seeing in the market with them, how often we're reviewing credit, product lines they're carrying, what they're seeing in the market, and then we organizationally have your typical QMI, like quick market, right? So we will do that with our entire sales, and we'll talk about what we're seeing, and it's not just about what we're seeing in trends, financial trends, but it's also what we're seeing in some boating trends, what units seem to be selling, what suppliers seem to be doing well, because it's very important for us to have that kind of institutional expertise, both sides, because it's important for us to share it to the market, but it's really, really important for us to be able to share it within the bank too, so they understand this business and appreciate the complexity that is the marine market.
Right, and it is very complex, that's for sure. So yeah, you've got a great team. Of course, we know your team extremely well, and you and both Brian both attended our strategic planning meeting, and that was great to have you guys there as well. You play a very important role in our industry, and I'm sure, like I said, we'll see you at a lot of these different dealer meetings out there. You talked a little bit about staying in touch with the dealers and having a pulse on what's going on out there. What are you hearing from dealers in today's marketplace? What are they, it's kind of been crazy out there this last couple of years, and things seem to be maybe slowing down a little bit, but what are you hearing?
So you're seeing the market, we use the term normalize, right? So that's, sales and inventories returning to pre-COVID levels, right? That's what we're kind of calling, not to pre-COVID levels, but close to pre-COVID levels. What the themes that we're hearing is interesting is a couple things. One is the resiliency of this consumer. That they're generally speaking, every meeting that I've been to, and I've been to a few dealer meetings, and we attend all of them, right? Like 60 of them. The general feedback is most of the dealers are feeling that there's a resilient consumer, given all the negativity between war, interest rates, fuel prices, inflation, et cetera. And most there's still a big desire to have more inventory. So even though there's some economic uncertainty, all of the dealers are looking for and feel like they could be selling a little bit more if they had a little bit more inventory. So we're still, in our numbers would show it. I mean, we're still about half of where we were pre-COVID in terms of inventory. So it seems like there's still a confidence in the consumer and a desire to continue to replenish inventory levels is really kind of those are kind of the two themes that I keep continually hearing.
Yeah. And it's the inventory levels really kind of drive the sentiment that the dealers have out there, how good they're feeling about the marketplace. I remember, so back in, most of these dealer meetings are just now coming back online in person and that sort of thing. Some of the last batch of dealer meetings that I was at, late 2019, and we were in a different place, of course, at that time. I remember Wells Fargo was talking a lot about, hey, the pipeline's getting a little bit higher than we'd like, a little bit more full of boats than we'd like. I remember there being a lot of chatter about dealers and manufacturers working together on how are they going to reduce these numbers of boats that are starting to add up a little bit. We can all look really back at what happened in early 2020 now, right? Obviously, we understand that the market took off and we saw record numbers of sales and so forth. What do you think that we've learned from the height of maybe a little bit too much inventory to today, or the last few months or years where we've had no inventory or too little inventory for sure? What do you think we've learned through all those drastic ups and downs as an industry?
So I would hope two takeaways. These are things that I think about. One is the supplier relationships. I feel like the people that won in this kind of COVID piece, and this is not just in the boat business, but my observation in the businesses we serve, the people that won had the good relationships with their suppliers and their supply chains, because there's such a tension. That can be such a tense relationship at times that the people that were collaborative, that were transparent and worked together, were the ones that were successful in navigating some of the product shortages and that sort of thing. So hopefully that we build a better relationships across our supplier base as a collective group. I think the other thing is that everyone got to see how much more profitable these industries can be with a little bit of a different management on inventory levels. I don't think it's not. We had 6 weeks of inventory last year, right? And now we're at about 13. That's probably too low, right? It should be probably 20, but it doesn't have to be necessarily 30. And so how do we find that level of efficiency where you've got enough product, where you're maximizing the sale opportunity, the factories are able to maximize their production, but it's not to the comment you were making, where you're getting to times where now starting to discount inventory, and you're seeing things that are starting to age out, and you're starting to create some uncertainty in the environment. How do we find that kind of that spot in the that sweet spot? And I think people have seen it. They kind of understand it. It's just a matter of kind of, again, it goes back to the first comment. How do we kind of work together to get there?
I think that's the question right now that I think the industry is dealing with, right? We're trying to start looking at how do we manage that inventory going forward, and your question, how do we define that sweet spot? Do you have an answer for that, or do you have a thought on where that could be?
I don't have a specific, like what the appropriate inventory levels were. I don't really have a spot, because I recognize, just talking with dealers, right, that even today, I just mentioned it, right, one of the feedbacks is they want more inventory. So people feel like even though sales are really strong, They could be better because they're missing opportunities, or people are willing to wait as long as they were a year ago, right? So obviously there's needs more. But how much more is that is a question I don't. I honestly, there's one I wish I had a really good lens on, but it's a hard one.
It's interesting. So MRA produces every month what we call a pulse report, and one of the key functions of that pulse report, like they do in the RV industry, is a dealer sentiment graph, right? The graph, if you look and watch it closely, mirrors inventory levels. So as inventory levels drop a little bit, the sentiment seems to rise, and as inventory levels pile up a little bit, the sentiment starts to fall. But we got into this weird moment over the last couple of years where the inventory was so low that they were clearly not happy about it, and they were starting to think that their sentiment, their long-term view was off. I think I think you're spot on with the point in that the question becomes, how do you manage this going forward, and is there? So I guess one other question on this: do you feel like there's a lesson in there somewhere? A lesson in there somewhere where maybe the manufacturers and the dealers now know how to work together better, where they can consult with you on that and really start to figure out how to better manage those numbers, because everybody wants more boats right now. Mm-hmm. But at some point, there's going to be this, you use the word sweet spot, there's also going to be this kind of tipping point where there's too much. Right. And how do we manage that?
Really good question. I would say I think about the RV business. In the RV business, the production recovered much quicker, right? So they're back to kind of normalized inventory levels, and you're seeing a reduction in shipments, right? So they got the inventory. This is kind of my lesson, right? They got the inventory levels back to where they should have been in units. Now I think they needed to, but the pace was too fast. It was growing too fast, and now the dealers were taking product, but I don't think they were always getting the product that they really wanted or best for their retail operation, right? So now I think they're going to go through a little bit of kind of reorganization there. But I think it was really a collaborative between dealer and OEM, and I think that when the boat business gets to that point, when the OEM's production reaches those levels, I think that there's going to have to be those discussions that are going to have to be open, because I think because the OEMs have had you look at the publicly released numbers, they've had good run as well. So it's not just the dealers have benefited from this, that everyone but the floor plan finance companies have really
Yeah.
If I could put a small plug in for us.
Understood.
But it's both have been profitable. So yeah, I think they both have seen the sweet spot. Now how do you guide it there?
Right. And I think you nailed it with the very first part of the answer, which was the relationships, right? The relationships between the dealers and the manufacturers, the dealers and you, the manufacturers and you, and I think we'll find that way to manage it. And I think 2019 was actually a really good example of that. We were still fresh out of the Great Recession and feeling the pain of that, and now all of a sudden, for the first time, our inventory levels were getting too high again, and everybody was talking about it, and everybody was working together. So hopefully that's an approach that we can continue as we move forward. One of the great benefits that dealers have when they work with you and your team is that you guys collect and provide them with the statistical surveys data, the market data. And you talked a little bit about that previously, but as you're looking at some of the data that's available to us now, are you starting to identify any noteworthy signs of upward, downward movement in any of the particular market segments or the regions of the country? Is there anything happening out there that is noteworthy?
I would say if you kind of look at the segments, the yachts, the larger offshore fishing segments still seem to be, in our books, still incredibly hot. The one segment that I would say we're seeing a little bit, you see it in the SSI data, that there's kind of the aluminum category. We're seeing a little bit slower than market in terms of retail, and we're actually seeing lower shipments, the volume we finance. So I would say that that's probably one segment that would be noteworthy, just as an observation. How it's funny, I call it noteworthy. The turns are still 3.5 times, which is still way above. So, but that would be the one area that seems to be a little bit slower at retail than the rest of the segments, and a little bit slower at wholesale than the rest of the segments. Yachts, sport fish, those are still faster. And then we're seeing a reasonable recovery, and I call it recovery, but you're seeing a little bit of retail unit decline and kind of the runabouts and the towboats, but you're seeing a pretty good increase in their shipments. They're 30-some% up, right? So you're seeing a pretty good. So we're starting to see they're actually starting to. You still see a healthy consumer, but you're starting to see some product build, a little bit of inventories build there.
Right.
So if I kind of look at the segments, two that are still kind of really hot, not building a lot of inventory. One that's probably needs to watch a little bit, and the other two that looks like it's a nice, healthy build back in inventory.
Perfect. So out at these dealer meetings, one of the things that I'm hearing a lot is that things are still going well, still don't have enough inventory, maybe that there's a little bit of a slowdown, but just slight at this point. One of the things that that the dealers are starting to identify, of course, is that there's this little bit of stock market volatility. You mentioned war earlier, and the interest rates and the rising prices of boats and so forth. I'm curious if you feel like some of these, if there is any softness out there, if there is any of this perceived slowdown, is it due simply to lower demand in the marketplace, like from the consumer side of things, or is it due to some of these other extraneous factors like the interest rates or the war or whatever it might be?
So my view is the consumer that buys boats is very healthy. There was a big buildup in wealth through COVID. The stats show that the excess savings was a couple of $1 trillion, right? Those are predominantly into boat buyers. So I think that there's probably some hesitance because there's a lot of uncertainty. I've never had more discussions on economic data than I've had every customer we have wants to talk about the outcomes of the economy because we're in such a, it's been a pretty constant, unique time, but now we're probably in the most where there's actually kind of this inflation fight. The Fed is really going to force the economy to slow down, and normally economy slowing down is not, that's not correlated well for the boat business. However, I think the consumer that is purchasing the products is still really healthy, and I think the low inventory levels are still really healthy. That I feel like that if there is going to be a recession or some sort of decline in GDP and some sort of headwinds on the consumer spending, I feel like the boat business is positioned pretty well to kind of skip across that a little bit. Right. I really do.
Yeah, we've got a ways to go before inventory levels are too high or even normal.
And what I think what's happening with the economic activity, in my view, is going to be short. It's a year. It's probably 23 is going to be really volatile, but I feel like once you start to see the economy slow a little bit, once you see unemployment rise a little bit, and you see the inflation numbers start to trend down, I feel like that then you will see kind of a little bit. Should you see a little bit of a return, a little bit. So I don't think it'll be particularly. If there's a little bit of a slowdown, I don't think it'll be particularly long.
Right. So translate that a little bit to the boat business itself. Next, you mentioned 23 will be a little bit volatile. In the boat business side of things, next 12 to 24 months, are you guys projecting? Are you guys looking out and expecting a certain level of business? Our forecast is probably light single-digit decline at retail in terms of units. I mean, that's not a lot, given all the uncertainty. There's still enough pent-up demand. There's still enough good consumer balance sheet and the lifestyle is still popular. We talked a lot about, last year we did a lot of analysis on the new first-time boat buyer. So we know the market's a little bit incrementally, a little bit bigger, so you can see some trade activities. I mean, there just feels like there's enough good that it's that you're gonna see a little bit of decline, but I don't think it's gonna be. We're not forecasting it to be major. Right. So there's enough good out there, and as we're talking about some of this market volatility, the stock market, dropped 1,000 points or whatever on Friday before we have this conversation. As you look back at what happened in the 2008-2009 timeframe, are you seeing anything this time around that resembles last time? Last time we had too much inventory, and then boat sales just stopped. This time it doesn't feel like that's there. Are there any similarities at all? There
are very few similarities in my opinion, because if you look at the macro economy, so you're seeing the housing prices are dropping, right, and new housing starts. So housing was a big part of the 08-09 crisis. But there was way too much supply. There's no supply. So it was really a demand. And with interest rates going up, you're seeing demand curtail a little bit. You're not seeing the banking problems, right? The banks are not overly leveraged to the. So I'm not seeing the similarities. And if you look at the run that the industry's had, I mean, realistically, you've had a couple of really strong years in terms of margin profile, sales profile. So the balance sheets of the dealers, the balance sheets of the OEMs, the inventory levels, the balance sheets of the consumer. There's every one of those line up is really in a pretty good spot relative to, 07 when people are not losing. They're losing a little stock market wealth, but but it's still up a lot, right? In the housing, it's not like everyone's invested in the housing in quite the same way it was in 08, 09. So I'm not seeing a lot of similarities in that respect. So again, my view is you're going to have a slowdown. There's no way to kind of avoid it, but it's not going to be to the level that anywhere near the level that it was then.
So we talked about this a little bit previously, and so I don't know if there's a way to target a specific level of inventory, but as we start to look at these dealers replenishing inventory, as the manufacturers wanting to build more and build faster and that sort of thing, is there a goal of ours? Should our goal be to return to the pre-COVID levels of, we'll say 2018, because again, we know 2019 got a little bit too high, but should that be a goal to get back to that level? Or are we going to land somewhere less than that?
I suspect it'll be somewhere less than that, because I think, to our earlier conversation, I think the industry has kind of felt felt the good of the optimization. So I think that there's going to be a desire to have a little bit of optimization in terms of inventory. So I think it'll be a little less than that, but it'll be close. I mean, I still think this is an industry that you need to have you need inventory. People, they need to see the product. They need to see and compare and contrast products. I mean, I don't feel like that part of the consumer. There's more migration towards online and certain things like that, but I still think some of these durable good businesses like the boat business, inventories are still going to be an incredibly important part of how the market operates. So I'd say it's going to be close.
Right. People still like to kick the tires and sit in the boat and go to the boat shows and all that sort of thing.
Correct.
So one of the things that has popped up as questions from a couple different people I've talked to in the last couple of weeks, as we look at, again, replenishing these inventory levels, some of the concern is, of course, the price of boats has risen significantly over the last 2 years. And as those manufacturer invoice dollars, the values increased so much, what are your thoughts on the potential of dealers needing to really reevaluate their credit lines and raise the credit lines? Is that a reality?
It's significant. We're already starting that process, and as we're at these dealer meetings and talking with the dealers, it's going to, because to your point, the price of the average price of the unit's up a lot. As the inventory numbers of units return, they're going to be higher than they were pre-COVID for sure. And we didn't do a lot of line increase the last couple of years because there hadn't been a lot of inventory. And so we are really spending some time trying to talk with the dealers and a little bit with the OEM partners about how they're thinking about their credit limits and kind of how they're thinking about inventory returns, because it's going to happen. It'll happen quick. Because the inventory, I suspect you will see, you'll see supply chains improve, you'll see throughput improve, and it'll happen fairly quick. And it's not something that people are top of mind, and we're trying to make it top of mind because it will for sure happen.
It's going to sneak up on them.
Yes.
What I'm hearing in the RV industry is that what you just said, they have maxed out their credit lines, but they have nowhere near the number of units that they normally carry, and so they've had to go back to the drawing board.
I will speak to our business. We, in the first quarter, right, we had this was really what happened. That their production recovered very quickly, and you're right, dealers were starting to hit their credit lines because the price was up, and so we spent the first quarter really underwriting and improving a lot of credit lines, and we have a lot less units we have more dollars on our floor plan than we did pre-COVID, and we have less units. I mean, we have about 10% less units, and I think that again, my suspicion is that that's probably going to be, that'll probably kind of hold.
Wow. So you guys are the largest player out there in the industry on the wholesale side. Do you believe and feel like Wells Fargo is well positioned to meet those demands as the dealers need to increase?
I think we are. Yeah. I do. It's been a good it's been a good run from a dealer profitability perspective, and I think it's an industry that we're very comfortable with. So I think we're really positioned to support it, continue to support it.
And you mentioned their balance sheets also seem to be in good shape.
Yes, absolutely.
So in your role, of course, we talked about this previously, but you also oversee the RV side of the business, and you just commented a little bit on what's happening over there. Over the years, there's been this belief in the marine industry that we trail the RV market in the ups and downs of the market, and some would say it's by a year, some say it's 6 to 8 months, 8 to 10 months, whatever that might be. Is that an accurate belief, and what's your view on how should we be monitoring ourselves against what's happening in the RV industry?
I don't know about historically, but it certainly happened this past year, right? I mean, and it's purely a throughput. It's a supply chain. The RV OEMs, production levels were able to ramp up and to replenish inventory. I don't know. They were down, call it 150,000 units probably at one point, and they built back about 70 or so. So I mean, they got their production ahead of marine, and I'm not smart enough to know all the nuances of why that's the case, but that's just it's an easy observation that I can make because I kind of watch both segments kind of work on it. So I watch and I talk about it all the time with our marine team about what we're seeing in RV, and we're actually adding a lot of RV stuff to our market decks because it is because when you see normalization, right? So you're going to see inventory levels return. There's a cost with the inventory, right? There's an interest cost, and the interest rates are going up. There's an employment cost that we've all had to face, right? You're going to see declining revenues, and you're going to see margins compress because you're going to have more competition in the market, right? So you're going to see a very specific P&L that's going to look worse than the prior period. However, which we just talked about in the marine business and very true in the RV business, if you go back and look, because the product is more expensive, the top line revenues are materially higher than they were in 18 and 19. Right. So even though the trends look negative on a year-over-year or period-over-period basis, right, they look really good relative to 17, 18, 19, which were really good years for both businesses, right? Right. Even though there was maybe an inventory overhang here or there, I mean, they were good business, they were good parts. So I think, and then we said the balance sheets are in better shape. So we're watching it closely, but we see that the pricing, there's a concern, right? The cost of the product is a legitimate concern the industry has. However, consumers purchasing product at the same pace that they did or 17, 18, or 19 at a higher price point is still a healthy. Right. It's healthy for the dealers.
Absolutely. You mentioned the decks and the presentations and so forth. You're here at the National Marine Lenders Conference. You're going to present tomorrow. Tell us a little bit about what to expect, and for those of us, our listeners that won't actually be here, maybe just give a summary of what the presentation's all about.
We heard a couple points, right? I'm going to talk a little bit about inventory levels. I'm going to talk a little bit about what we see in terms of normalization relative to a couple of the other businesses I mentioned that I used to run the electronics and appliance business. That was the very first business that saw kind of the COVID spike, and then what normalized is looking like there. RV, obviously talk about the marine, the inventory levels, how we're kind of forecasting inventory levels. We're kind of saying maybe the fourth quarter of 23 will start to be back to something closer to normal weeks on hand of inventory. So it's really to give these marine retail lenders who cover and deal with the marine dealers, right, in a different way, kind of our viewpoint of how the health of the business and the health of the market and what that normal, because I do think there's some concern around normal, but I also think that there's some opportunities too. So it's a little bit of just trying to kind of be as candid as I can about how we're kind of seeing the market. So
that's great. So one of the big questions that dealers are asking and talking about right now, this kind of flows or threads the needle through all of the stuff that we've been talking about, but with all of the stuff that's happening in the marketplace, whether we look at RV, whether we look at the stock market, whether we look at consumer confidence, whatever that is, what economic indicators do you feel that dealers should be watching as they are making key decisions about how to manage their business going into 23 and beyond, all the way through until you said Q4, when we might have normal weeks of inventory on hand? What are those key economic indicators that they should be keeping an eye on?
I'll just tell you when we sit down and talk to customers with the deck, right, the first things we talk about is where how the bank is, because the Wells Fargo economics team, right, how they're looking at GDP, interest rates, short-term and long-term interest rates, unemployment, inflation, housing. Those are the numbers that we talk about in the trends and what the forecasts are probably the most. Obviously GDP's, kind of, but what's happening with housing seems to have some correlation to boats, though. The obviously interest rates are a big factor from their managing their own dealership, plus retail rates and that. So we think those are kind of the key pieces. Yeah. And obviously you want to see a little bit of the macro inflation recover, because if you start to see and I think this is probably the most important metric right now is the CPI or core CPI or whatever, because the Fed's not going to, interest rates in the economy is not going to get to its normal path until those numbers start to get down towards 2 to 3%. And so that's probably the most important near-term one. So the Fed's going to continue to increase interest rates, we think, until they see that number. Right. So if you start seeing that number trending in the right direction, that's probably one of the better signs. And if it's not, then it could be a little harder. It could get a little harder.
Further out.
Yeah.
So, as you know, giving dealers those insights and trends and things to be watching for and so forth, that's a key pillar of what we do at Dealer Week each year. Not to make some shameless plug here for the event, but I wanted to take the opportunity to say thank you to you, because Wells Fargo has always been a significant supporter of MRAA, of Dealer Week, and I know that as a strategic partner, you were there with us this year to help us craft our 3-year plan and our 3-year vision. This podcast was one of the things that came out of that we should start having these types of conversations. But I do want to just take the moment to say thank you for the support and all that you've done for MRA over the years and for Dealer Week and so forth. So thank you.
I appreciate that a lot, Matt. And we like the group a ton, and what you guys do is really, dealer education, dealer health. That's really, it's so important to everyone. That's such a focus of ours, and so obviously anything we do to support you in the group is important. It really is.
Well, I think we make great partners that way as far as focusing on that dealer health and dealer education and so forth. So this has been a really great conversation. I really appreciate you taking the time out. I know you've been prepping for the presentation tomorrow, and we got to get ready for the event that's taking place here tonight. So I just want to say thank you for taking the time and chatting with me for a little bit. Looking forward to tomorrow's presentation. I got to present on Tuesday, so maybe I'll be able to pick up a few things that I can provide some reference to as well along the way. But looking forward to that presentation and of course to seeing you either at dealer meetings or at Dealer Week in December.
I was going to say Dealer Week for sure, obviously, but and then I'm sure a dealer meeting or two along the way. So yes, thank you. This was a lot of fun.
Absolutely.
Enjoyed it.
Appreciate your time. Ladies and gentlemen, thank you once again for joining us for the third episode of the Boat Biz podcast. Another great conversation and a deep dive into some of the key elements of the business of boating, and we do appreciate you joining us. If you're liking this podcast, please subscribe. And if you have any ideas or topics, or you want us to invite a special guest or somebody you'd like us to feature on the show, please reach out to us at any time via the email at theboatbiz@mraa.com. We appreciate you joining us, and we'll see you out there next time.